If you're a UK landlord, you probably know that the tax side of things can be, well, a bit of a minefield. And, getting just one thing wrong can end up costing you thousands. So, over the next few minutes, we're going to clear up exactly how your buy-to-let property is taxed, making sure you can steer clear of any of those costly surprises.
Now, this whole discussion has been put together by the experts over at My Tax Accountant, and their goal is pretty simple, really. They want to help demystify the rules around buy-to-let tax, helping landlords just like you turn all that complexity into pure confidence. So here's what we're going to cover. We'll start with the basics of your tax reality, then look at how to calculate your bill. We'll tackle that huge mortgage interest change, cover buying and selling taxes, point out some common traps, and then we'll finish up with a simple annual health check. Sound good? Let's get started.
Okay, Section 1, a landlord's tax reality. Let's kick things off with the single most important rule you absolutely have to understand.
And here it is. Your rental profit isn't taxed separately in its own little world. No, it gets stacked right on top of all your other income, like your salary from your day job. And what that means is, it gets taxed at your highest personal rate, which, as you're about to see, can have some pretty huge consequences. Just look at how quickly that rental income can push you up into a higher tax band. Because those personal allowances have been frozen for a while, even a relatively small rental profit can easily tip someone who's a 20% taxpayer into that 40% bracket. And honestly, this catches so many people completely by surprise.
So how exactly do we figure out that profit number? Let's break down the journey from the gross rent you get in your bank account to the actual tax you'll have to pay.
To make this real, let's meet Sarah. Okay, so Sarah earns 35 grand from her job. She also gets $18,000 a year in rent. After we account for $3,000 in expenses and her $5,000 in mortgage interest, her total taxable income hits £50,000. That puts her right on the cusp of that higher rate tax band.
This is the process, step by step. You start with the rent you've received. Then you subtract your allowable expenses to find your profit. Then you figure out the tax. But notice that last step? The mortgage interest credit is applied right at the very end. Why that order is so critical? Well, that's exactly what we're about to get into.
Right, let's talk about the mortgage interest shock. I am not exaggerating when I say this is the single biggest change to landlord tax in a generation, and it's the one that trips almost everyone up.
Just look at the difference here. Under the old rules, you could deduct your entire mortgage interest bill from your rent before you worked out your tax. It massively lowered your taxable profit. Now, you can't do that. You pay tax on the full profit, and only then do you get a flat 20% credit back. This is what absolutely clobbers higher rate taxpayers, because they're paying 40% tax, but only getting 20% relief. And listen, this isn't just some theory. Let's take Mark, a real-life higher rate taxpayer who earns $60,000 a year. He'd done his sums based on the old rules, thinking he could deduct his mortgage interest. The reality was a massive shock. His tax bill didn't just creep up, it literally doubled. For Mark, that new rule meant he had to find an extra £3,200 for his tax bill in a single year. That's the real-world cost of this change. It just goes to show understanding these rules isn't just a nice-to-have, it's absolutely essential.
Okay, so beyond the tax you pay every year, your journey as a landlord is bookended by two other big costs: the tax you pay when you buy and the tax you pay when you eventually sell.
First up, you've got stamp duty. And that 3% surcharge for second properties is a massive upfront hit. I mean, on a £250,000 property, the tax bill skyrockets from £2.5 grand all the way to £10,000. That's an extra £7,500 that a lot of new landlords just forget to budget for. And then, when it's time to sell, you've got capital gains tax. This is basically a tax on the profit you've made over the years. The rates are either 18% or 24%, but here's the real kicker. The tax-free allowance is now just a tiny £3,000. That means pretty much any gain you make is going to land you with a tax bill.
Okay, time for a quick fire round of the most common and the most costly tax traps that landlords fall into.
So you really need to watch out for these. First, your rental income pushes your total earnings over 50 grand and suddenly you're getting hit with the child benefit charge. Second, HMRC fiddles with your work tax code to try and collect the tax, and it causes chaos with your monthly salary. Third, you mistake a capital expense like fitting a brand new kitchen for a deductible repair. Fourth, if you own the property with someone else, you forget to tell HMRC how you're splitting the income. And fifth, you think that little bit of side hustle rental income goes unnoticed. Trust me, it won't.
All right, enough about the problems. Let's switch gears and talk about a simple, proactive health check that you should be doing every single year to stay in control.
Think of this as your annual MOT for your property finances. Every year, you should recalculate your profit, double-check that your mortgage credit and tax code are right, keep a close eye on those income thresholds, and, this is the big one, proactively set cash aside every month for your tax bill. Please don't wait for that horrible surprise in January.
And you know, this all boils down to one final, really crucial question. When you see the potential pitfalls, like Mark's surprise bill for over $3,000, it really makes you stop and think, doesn't it?
So, if you're ready to get some proper clarity on your property tax, getting personalized guidance could be a really smart next step. As Mark's story shows, professional advice isn't just another expense. It's an investment in your financial security and, frankly, your peace of mind. To find out more, you can always reach out to the team at My Tax Accountant.